Good morning, everybody. Hope the week is treating you extremely well. We have a lot to cover in this week's video. We're going to take a look at the four major U.S. indexes. We are also going to jump in and take a look at some breadth readings, and we're going to take a look at some Wall Street analyst upgrades and what that could mean for us as we head into the first quarter earnings season. So let's jump right into it. Technically, S&P 500 looks extremely well. We talked about this a lot last year, that 30-20 level. Once we broke above it, the market really hasn't looked back. It's up about 8.5% from that breakout level. All the moving averages are aligned correctly. We got the 10 over the 20 over the 50. Earlier this week, we had a lot of volatility in the market. In fact, with the news out of Iran, the market saw a new multi-week low in the futures after hours, proceeded to rally all the way back and make a new all-time high. That has never happened before in the history of the S&P futures. So once again, it's just showing really strong resilience here for the overall market. All the dips so far have been bought. Nasdaq, same setup. 10 is over the 20, it's over the 50, holding above that breakout zone. We take a look at the Dow Jones, same setup there as well. And of course, the one outlier being the mid and small caps, the Russell, still has not made a new all-time high, and in fact, we're still 5% off of the high. As we saw in 2019, we talked about the Russell a lot and its importance. The rest of the indexes have continued to trug along higher. It would be great if the mid and the small caps would participate and make those new all-time highs, but as we saw throughout the course of the end of last year, even without the Russell making those new highs, the rest of the indexes were able to continue to push and head higher. It's still worth paying attention to, but perhaps the mid and the small caps don't matter as much to the rest of the indexes as they used to in terms of determining risk on appetite. Now, one of the things that I do want to discuss today is even though the market continues to just rock and roll higher, we are doing so at a high rate of ascent. And you'll notice that when we go back to 2017, we had an angle of attack like this, and then we moved a lot sharper to the upside. And that, of course, sharp move to the upside a lot of times is not necessarily sustainable at that level. When we take a look at the action last year, we have a similar type of setup where we had a 45-degree angle to the upside for the majority of the year, and then the last quarter essentially just a violent move here to the upside. Now, that doesn't mean that we are going to have a sharp sell-off like we had back in 2018 at the start of that year, but it's worth paying attention to note that at some point we're probably going to need to either consolidate sideways or make a little bit of a pullback because the market just can't go up forever in that angle of attack at that steep of a rate. So that is really the only area of concern that I've got from a technical standpoint, is that we really are moving up at a very quick pace here, and a little bit of a breather might make some sense. When we talk about sentiment, where we're currently at is still at a very extreme rate. The dumb money, smart money confidence spread is still extremely wide. It's starting to close the gap a little bit. It's not as wide as it was, say, a week or so ago, but it still has a long way to go before we get that inevitable crossover that we ultimately will get at some point in time during the next pullback, so to speak. So paying very close attention in on this. This is one of these things. It's just a reason to be cautious. It doesn't matter until it does, but we want to continue to stay on top of it. The other thing I wanted to take a look at here is the breadth reading. We discussed this a lot last year. We talked a lot about the importance of this 300 level, and once we broke above it, we've seen a nice rise. Now, where do we stall out? We've stalled out right here around that 500 level, that same zone of resistance from back last April. So this is important, what happens here, and what we're noticing over the last week, even as the indexes continue to head higher, the breadth readings are kind of stalling out right here. So what happens here over the next week or two, to me, is very important. If we do get that break, we would have that run back, and we can see that there really is no overhead resistance for a while higher. And if we start to stall out here, the area that I would look for support would be back towards that breakout level that we saw there at the end of December. So it's worth noting that even as the indexes have pushed higher here over the last week or so, breadth has stalled out. That's a little bit of an area for concern. The other area for concern is Our Wall Street analysts. Now, we like to pay attention to where expectations are heading into earnings season. When expectations are very, very lofty, it's difficult for companies to beat those lofty expectations, and you run into those scenarios where the stock may beat their earnings target, but not by as much as the market expects, and you have companies that beat and still move lower after earnings. The flip side is also true, where sometimes expectations are so unbelievably abysmal that the companies don't have to do much of anything to beat those abysmal expectations, and we can see sharp rises to the upside. So paying attention to, as a whole, what people are expecting out of companies going into earnings season from a sentiment standpoint is important. The higher the expectations, the loftier essentially the risk is that the companies are subsequently going to see some pullbacks based on where expectations currently are. Now, Wall Street analysts have raised their price targets on over 100 stocks going into this earnings season. Now, this is on the same day they've upgraded over 100 stocks, not over the course of the last couple of months. A single day. Now, there is a number of readings for that here over the years. And what we'll notice is 1 month out. Look at the returns 1 month out. They are not very good. Now, as we head past the 3-month out zone, we start looking really good in the 6-month area, and then a year later, the numbers are really not very good. So we can take a look here. These are some pretty bad numbers. We're only a third of the time we're positive. Big skew risk to reward wise. And again, that makes sense when you start thinking about things in the line of if expectations are very, very lofty, it's very difficult to hit those metrics, and subsequently we're getting those upgrades a few weeks in front of earnings season. Earnings season happens, right? Stocks tend to pull back with those really, really exploded expectations to the upside. So this is something to pay attention to as we head into earnings season in terms of we might want to be a little bit more cautious. Things are very, very, from a sentiment standpoint, frothy, I would say. Sentiment readings are extreme. Breadth readings are starting to pull back a little bit. Everybody's upgrading stocks. Like, there is a good concern here and a good reason to essentially be cautious from a sentiment standpoint. From a technical standpoint, guys, the market's still extremely strong. So this is one of those zones where we just want to pay very close attention to what's going on underneath the surface. All right, we've had a phenomenal run from this breakout. All right. Typically, at some point in time, we're going to consolidate or pull back a little bit. Most breakouts don't just go straight up forever. This angle of attack is a little bit of a concern. But overall, we started the year off extremely strong. We ended last year really strong. When you look at the historical numbers on that, really how the end of the year, the start of the year goes, on average, so does the year. So we've been up at the end of the year, the beginning of the year. On average, that would mean we would have a positive year for the market. That's not always the case, but historically, how the year ends, how the year starts is important for the context of the entire year and the entire year's results. So, as always, we're going to pay very close attention. I hope you guys have yourself a phenomenal week. As always, if you guys have any questions, feel free to reach out to me. You can reach me at mtedeschi at Perspective Wealth Planning, or you can reach me on the phone at 814-580-9881. I hope you guys have yourselves a fantastic week. Take care.